Hello, everybody, and welcome back. How will interest rates and the economy develop in Europe and the US in the coming months? What are the investment options in equities and bonds for investors? Today, I talk about this with Stephen Bell, Chief Economist, Europe, Middle East, and Asia at Columbia Threadneedle. A warm welcome, Stephen.
Good morning. Hello.
Stephen, the European Central Bank has raised the interest rates for the 10th time in a row. Was that it for the interest rate hikes in Europe?
Well, I think interest rates are pretty close to their peak. The problem is, for all the technology involved, running a central bank and guessing interest rates is fumbling in the dark, and particularly in Europe where there are so many cross currents present. But I think we're going to see a significant rise in unemployment in Europe. I mean, it's actually in Eurozone very low indeed, record lows, but the rise in unemployment will draw a veil over inflation. And I think with headline inflation coming down, we should see a significant change to the background, with sadly a rise in unemployment from low levels, lower inflation, and interest rates will be cut in 2024. Not early. The European Central Bank will delay, but that's my outlook.
The market is already speculating on interest rate cuts in the US and Europe. Does the current inflation trend support this?
Well, the inflation trend in the United States is pretty clear and clearly does support lower interest rates towards the end of this year or into next year. And the reason for that is if you look at the latest consumer price index, it was only up 2.4% on a 3-month annualized basis. And that's lower than it was 6 months or 12 months basis. And the reason for that is we're getting inflation falling in the US. We call it the immaculate disinflation. And a lot of that's to do with the margin squeeze, the flexible labor market. So I see a very rosy outlook, if you like. The Fed have almost done enough, and the economy will have a soft landing with a bit of a rise in unemployment, and interest rates will fall there first of any major country. It's more complicated than Europe. Wage inflation is higher, a bit more persistent. Unemployment is lower relative to its history than in the United States. So I think it may take a bit longer. But in Europe too, I see really the end of the dark period coming. But it'll be a while before the ECB feel ready to cut interest rates.
Recession or not, what will the coming month bring for the EU economy in terms of inflation and growth?
Well, for Europe, it may be that Europe is already in a mild recession. The starting point is very favorable. Unemployment is very low. And because interest rates have risen, we can get relief when they're able to cut rates. But I think the weakness, delayed effect of the Ukrainian war, the effect of this sudden rise in interest rates really has sapped strength in Europe. And we may see a mild recession in Europe. You don't need a big recession in Europe to get wage inflation down. A lot of the wage awards involved one-off payments, much easier to cut than basic pay. So I think there will be a quick response, but I'm afraid the outlook is a bit gloomy in Europe relative to the United States, where I think they can get away without a recession, or at any rate, certainly a mild one.
A dispute with China over electro vehicle subsidies is looming. So how do you assess the situation and the potential consequences?
I don't think the issue of protectionism for electric vehicles is that significant for interest rates and so forth. It's just one of many examples of protectionism. The pendulum towards free trade versus protectionism is swinging very severely in favor of protectionism. And when you get big industries like Europe's car industry, particularly in Germany, suffering, then you will get that protectionism. The carbon border adjustment mechanism is another way that we're just going to, if you like, penalize free trade. The consumer loses and big business wins. But I hope it doesn't develop into a real big war.
What are the current drivers of the US economic development, and why do you think there will be a soft landing?
So to my amazement, the US has really got on top of inflation without a recession. I don't think I've ever seen it before in any major economy, getting inflation down from, well over 5% to the current low rate has been achieved without a recession. Part of it's a flexible labor market. A lot of it is actually margin pressure. An awful lot of people in jobs like mine, for example, our wages don't rise and fall according to unemployment. They rise and fall according to profits. And there's been a profit squeeze in the US US S&P 500 companies have seen earnings fall in both Q1 and Q2, and smaller companies have suffered even more, and that's put downward pressure on wages, which are now much more flexible. Part of the benefits of having a phone is you can see what jobs are available in an instant. So that flexible approach has been really helpful. Of course, they've had a big rise in mortgage rates, and their mortgage rate system means you can stick with your mortgage unless you move. So house moving has really suffered. And I think there's greater weakness in that because of the recent rise in mortgage rates. There was some relief earlier. So the drivers are fiscal policy, expansionary in the medium term, but not immediately. Interest rates having risen, people have adjusted to it, and the margin squeeze may well recede in 2024 as wage inflation falls. So I think we can see a reasonably robust outlook for the US economy. Real wages are now rising, which is a positive for the consumer, but it's not a strong growth, and a mild recession is still a distinct possibility. I wouldn't be surprised if unemployment rises above 4%, which will raise lots of fears of an outright recession, even if it turns out to be very mild.
What do all these developments mean for risk assets? How and which stocks are attractive in the current environment?
So I think the big increase in short-term interest rates has beaten up bonds, and I think by and large they're attractive. So if bond yields fall, that provides support for the stock market. In addition, we've had a big squeeze on corporate earnings, margin squeeze from every direction, and I think that margin squeeze is pretty close to being over as the battle against inflation is won, first in the US and then in the rest of the world. So I think the outlook for equities has actually improved somewhat. We were pretty cautious on equities a few months ago, but we're much less pessimistic on that front. And actually, the volatility of equities has really fallen significantly, which is very helpful.
How interesting are bonds in the prevailing interest rate hike cycle? And how should investors position themselves?
So I like to look at bonds in two bits. Let's look at the real yield. And in the United States and other countries, you have Treasury inflation protected securities, and that's a yield of nearly 2%. For the safest asset in the world, I think that's attractive. So we actually quite like bonds. I think they're very significantly attractive from that point of view. In addition, I do think that interest rates are close to their peak. I think they'll fall more than the market thinks in 2024. And so we really like bonds, particularly in the US and in the UK, where they've had all sorts of problems that have pushed yields up here. In Europe, yes, they're attractive, but just not as attractive on a relative basis than those other two areas.
So this was Stephen Bell, Chief Economist, Europe, Middle East, and Asia at Columbia Threadneedle. Thank you very much, Stephen, for being with us today and sharing your thoughts.
Thank you.